Hello everyone, welcome to my channel. Today I will explain about marginal costing. So in this video I will explain the meaning, advantages, limitations and conclusion of marginal costing in a very simple way. This topic is important for MBA and management studies. So firstly we'll learn about what is meaning of marginal costing. Marginal costing is a costing technique which considers only variable cost for decision making. In this method, fixed costs are treated as period cost, which means they are charged directly to the profit and loss account. The main concept of marginal costing is contribution, which is calculated as selling price minus variable cost. This contribution helps to cover fixed cost and then generate. And above, so let's take an example on the basis of marginal costing. Take a simple example. Suppose the selling price of product is 100 rupees and the variable cost of product is 60 rupees. So the contribution will be 40 rupees. This 40 rupees is first used to cover fixed cost and after that it becomes profit. This example clearly shows how each unit contributes towards profit. Now we'll learn about different advantages of marginal costing. The first advantage of marginal costing is that it is simple and easy to understand. There is no need to allocate fixed cost to products, which makes calculation easy. Because of this simplicity, managers can quickly use this method for the decision making. It is also better decisions. It used for better decisions. It helps in special orders, minimize prices, product profitability. Third one is break-even point. Marginal costing is very useful for break-even analysis. It helps in calculating break-even point, contribution, and PV ratio. Using this information, firms can forecast profits and losses, understand how much sales are required to avoid losses. This method helps in profit planning. It shows how profit changes when production or sales volume increases or decreases. Management can help to plan future production levels to achieve desired profit. Marginal costing clearly separates fixed cost and variable cost. Because of this, management can control cost more effectively. It helps in identifying areas where variable cost can be reduced. Now, we'll learn about limitations of marginal costing. One major limitation of marginal costing is that it is not suitable for external financial reporting. Accounting standards require the use of absorption costing for preparing financial statements. Therefore, marginal costing cannot be used for statutory purposes. In marginal costing, fixed costs are ignored for product costing. However, in reality, fixed cost may change due to expansion or increase in capacity. Ignoring fixed cost may lead to incomplete decision making. Marginal costing is mainly useful for short-term decisions. In the long run, fixed costs cannot be ignored. Therefore, this method is not suitable for long-term pricing and strategic decisions. Another limitation is difficulty in classification cost. Some costs are semi-variable, which means they are partially fixed and partially variable. Separating this cost accurately is difficult and may affect results. Marginal costing may lead to very low pricing decisions. If prices are fixed only on variable cost, fixed cost may not be fully recovered. This can be risky for the business in the long run. End of this video. To conclude that marginal costing is a very useful technique for short-term decision making. It clearly shows contribution and it helps in cost control and profit planning. However, it is not suitable for long-term decisions and external reporting. So, marginal costing should be used carefully along with other costing methods. Thank you.